Let's talk about SemCorp. It's the undisputed global leader in lithium-ion battery separators. But right now, its market dominance is in a direct and dangerous conflict with its financial health. In this analysis, we're going to dissect that very conflict and look at the significant risks now facing this unbalanced titan.
Our analysis really boils down to four key findings. First, SemCorp's strategy is all about prioritizing scale, but it's coming at the direct expense of profit. Second, this has pushed the company into its first-ever net loss in the first half of 2025. Third, we've identified significant governance failures that add a whole new layer of risk to its financing and expansion plans. And finally, that recent surge in its stock price, well, it's not rooted in fundamentals. It's a speculative, market-wide phenomenon. So let's start by digging into the central tension here, this fundamental conflict in SemCorp's strategy. The battle between maintaining market scale and actually achieving profitability.
In the first half of 2025, SemCorp's core business pulled in 4.82 billion yuan in revenue, a number that really cements its status as the world's #1 supplier. No question about it.
But that's the top line. The bottom line tells a completely different story, a net loss of 93.11 million yuan. Now, this is the first time the company has ever reported a loss, and that marks a major inflection point.
The data here presents a real paradox. So, how is this possible? How can the undisputed market leader be losing money? Well, the answer really lies in comparing its strategic choices and its operational efficiency against its peers.
And this competitive snapshot is incredibly revealing. You see, while SemCorp's revenue just dwarfs its competitors, its net loss is in stark contrast to the nearly 1 billion yuan profit reported by Sonoma. And look at this. SemCorp's inventory days are sitting around 120, way higher than the 75 days for its competitor Senior. This points to a deep, fundamental divergence in strategy.
And the reason for this divergence? It all comes down to SemCorp's aggressive global expansion. The strategy is to build plants overseas, like the one in Hungary, to lock in long-term contracts with top-tier international clients. Now, this secures future revenue, for sure, but the high upfront fixed costs of these new facilities are the primary reason for its current losses. It is a massive, high-stakes bet, sacrificing today's profitability for tomorrow's market share.
Okay, so beyond the strategy, our analysis also uncovered some significant, and I'd say latent risks hiding within the company's operations and its governance structures. And that operational risk, well, you can see it plain as day in their inventory. Holding 4 months' worth of product in a market with intense price competition, that exposes the company to a huge risk of write-downs. Not to mention it ties up a substantial amount of working capital. It's a clear indicator of operational inefficiency. Even more critical, though, is this finding from a recent investigation by the China Securities Regulatory Commission. It found, and I quote, that some raised funds were paid through non-designated accounts. Let's be clear, this is not some minor procedural error. This is a substantive governance failure that points to systemic weaknesses in their internal controls. And you can see how this creates a chain reaction, right? Lapses like this signal higher risk to lenders and investors, which in turn can lead to increased financing costs. And for a capital-intensive company like SemCorp, that could directly constrain the pace of its entire global expansion strategy.
All right, now let's shift gears and talk about the stock. We need to deconstruct the recent rally in SemCorp's share price to figure out if it was driven by fundamentals or something else entirely.
You see a 24% surge in just 5 trading days, and you have to ask, is this real? Is this the beginning of a fundamental turnaround? Or are we looking at a market illusion?
But when you actually plot SemCorp's performance against the broader CSI 300 index, the context becomes crystal clear. The stock didn't rally in isolation. Its upward trajectory moved in perfect lockstep with a wider market and sector rebound. This suggests the primary driver here was macro sentiment, not company-specific news.
And here is the crucial piece of data. On September 5th alone, 157 million yuan of new margin financing, that's basically money borrowed to buy stock, flowed into SemCorp. That high level of leveraged buying is a classic hallmark of sophisticated, short-term speculation.
So what happened is the rally followed the classic logic of a self-fulfilling prophecy. It started with rumors of favorable industrial policy. That catalyst prompted sophisticated investors to place leveraged bets. Their buying amplified the price signal, which in turn attracted trend-following investors, creating a feedback loop built on sentiment, not on substance.
So, let's pull all of this together. What's the forward-looking view? We need to focus on the key variables that will ultimately define SM Corp's future.
Look, the company's strengths are structural, and they are significant. It has absolute market dominance, deep integration with top-tier clients, and a real technological moat in both current and next-generation materials.
But, and this is a big but, these strengths are being counterbalanced by severe internal weaknesses. Profitability has collapsed, operations are inefficient, and we have proven governance failures, all compounded by a highly leveraged balance sheet.
Now, looking externally, the opportunity is absolutely clear. The long-term growth trends in EVs and energy storage, plus the potential for industry consolidation, they all favor a market leader, but only if it can execute its global strategy.
However, the threats are just as significant. We're talking about intense price wars, geopolitical headwinds, and the constant risk of execution failure on these new projects, or, of course, technological disruption.
This all brings us to 4 critical monitoring points. If you're watching this company, these are the questions you need to ask. Can management stop the financial bleeding and restore margins? Can they solve the inventory problem? Will we see tangible proof of governance reform? And, critically, can they execute their overseas expansion on time and on budget? The answers will signal any real turnaround.
And that leaves us with one final defining question. You see, SemCorp effectively holds a valuable call option on the future of battery technology, but that huge potential is currently being weighed down by significant governance and operational risk. So which of these two powerful opposing forces will ultimately define its future?